You've been told that getting an education and a good job are the keys to success. But what if that's what's keeping you trapped in the rat race? The wealthiest people I know focus on investing, not salary, and it's changing how we think about building wealth. Hi, I'm Dr. Shamim Nazir. Over my career, and especially since I started the Dr. Investor, I've been speaking with a lot of investors, bankers, and financial planners, and they tell me one thing: the wealthiest people are not working a job, they're investing. Now, before I share with you exactly what they're investing in, let me first explain why investing beats salary every time. When you work for money, you're limited by time. There are only so many hours you can work. Your income stops the moment you stop working. It's a never-ending treadmill with a built-in ceiling. But investing creates wealth through compounding. Your money makes more money, which then makes even more money. For example, if you invest $100 at 10%, the following year you'll have $110. And then next year, that $110 becomes $121, and so on. It works while you sleep and requires no extra hours and has no upper limit on growth potential. Plus, investment returns, if they're withdrawn at all, are taxed at capital gains tax rate, which is lower than regular income tax rate. And if you don't withdraw your returns and continue to reinvest, you would not pay tax on the gain at all. The government actually rewards investors with tax breaks because investing fuels the economy and provides the necessary infrastructure. For instance, investing in the stock market provides capital to the companies you invest in, and this increases production, distribution, and other aspects of the business, which results in more jobs. So what can you actually invest in? Well, the stock market is the most accessible option, buying shares in companies. As the company increases in value, so does your share price or value of your investment. Let's look at this example to see how investing works. If you had $100,000 invested at 8% annually with a monthly contribution of $500, you can double your money in just 10 years. The actual contribution over a 10-year period is $160,000, but the ending balance is over $300,000. That's $146,000 earned completely passively. But the wealthy don't just stop with stocks. They know that the key to investing strategically is to diversify across asset classes, especially non-correlated assets. A non-correlated asset is one that does not change in the same direction at the same time. A classic example is stocks and bonds. When stocks rise or fall, bonds hold steady. When you think of non-correlated assets, what might immediately come to mind is real estate. Now, most people think investing in real estate means buying homes, but commercial real estate is where the real money is made. Commercial properties with the right market and economics can deliver 12 to 15% annual returns, potentially doubling your investment in just 5 years. That's twice what you'd expect in the S&P 500. Yet surprisingly, most average investors never even consider it. What people don't realize is that investing in commercial properties is simpler than you might think. You can buy a building yourself or join forces with other investors through REITs, syndications, or crowdfunding platforms. What makes this approach powerful is the steady stream of rental income combined with the appreciation of the property itself. And unlike the stock market's wild swings, these investments tend to be remarkably stable. This counterbalance to stocks makes commercial real estate worth considering, even if you're already investing elsewhere. Let's look at REITs and syndications. Both let you invest without fixing toilets at 2 a.m. However, REITs and syndications attract completely different types of investors, and for good reason. REITs are essentially real estate stocks that you can buy and sell instantly on public markets. Syndications, on the other hand, let you pool money with others to buy massive properties worth tens of millions, something you can never access alone. REITs appeal to those who prioritize being able to cash out quickly and want a simple set it and forget it approach. Syndications attract investors who understand that the biggest wealth is created through direct ownership and tax advantages. These investors gladly trade liquidity for significantly higher returns and the tax benefits that can sometimes double their effective returns. If you want to learn more, start by downloading my free ebook on commercial real estate syndications. I'll leave a link in the description below. Even if you don't invest through a syndication, it'll give you valuable insight into how the investment actually works. Now, most people have considered stocks and real estate, but there's a secret asset class the wealthy use that most people completely ignore. It turns out directly buying small businesses generates some of the highest ROI in the investment world. And unlike stocks, you can take control of your investment immediately. Furthermore, when you invest in businesses, you're actually fueling the entire economy. Your investment creates jobs in your community and drives innovation. And the barrier to entry isn't always capital, it's knowing where to look. Family-owned businesses in a small town could be a good place to start. Choose a business that you're familiar with. Make sure you do your research on the market, the operations, and the finances. What businesses could you buy tomorrow that would change your financial future forever? The next asset class is one that is often villainized, especially in the healthcare world. However, the truth is billionaires are making the majority of their wealth through private equity deals that most people never get access to. So how does private equity work? Well, private equity firms collect money from wealthy investors, and then they purchase companies they believe are undervalued or underperforming, and they make improvements to operations, cut costs, and help the business grow. And after a few years, they sell these transformed companies for a significant profit. Unlike stocks that you can buy and sell instantly, these investments are illiquid, like many of the alternative investments we've discussed. That means they lock up your money for 5 to 10 years, but this patience is well rewarded with returns. And that's exactly why very high net worth individuals love it. They're playing for the long term. Now, private equity has a reputation for being ruthless. Many industries report the negative effects of private equity, including layoffs, reduced quality of services, and ultimately bankruptcy of some companies. Some studies show that private equity has delivered higher returns, while others say the returns have been similar to the stock market. Regardless of how investors and acquired companies fare, the private equity funds themselves are making exorbitant returns. So if you want to invest in private equity, I'd suggest treading lightly. You need patience, cash to spare, and comfort with your money being tied up for years. The ultra wealthy, however, diversify across all these options. They're building portfolios that work around the clock. Let's take a look at the JP Morgan Family Office Report. Now keep in mind, these are families worth at least 50 to 100 million in investable assets. They not only have the finances to obtain the best advice, they can handle significant risk. We can see in this graph that they have nearly half of their investments in alternative assets. Those alternative assets include real estate, private equity, venture capital, hedge funds, and private credit. All of these assets are illiquid, meaning you cannot withdraw your invested money easily. And also, because these assets are generally offered by private investment companies, they are less regulated. So proceed with caution. The ultra wealthy, on the other hand, they're not working for their money is working for them. I hope you enjoyed this content. Let me know in the comments if you've dabbled in any of these alternatives. Thanks for watching, and see you next time.